Hello everyone, I'm Bob Landaas of Landaas Company. Welcome to the Fall 2022 Landaas Company Investment Seminar. Hopefully we'll see you in person next year. This year we're going to continue filming in our studio in downtown Milwaukee. Joining me for the seminar is the president of the company, Kyle Tetting.
Thank you for having me back, Bob. I think plenty to talk about this year with a stock market that at one point in time was down more than 20% for the S&P, a bond market that certainly has been challenged at times, and plenty of stuff to talk about in the economy as well. But maybe the stock market, the best place to start. The S&P clearly having a difficult year, no sense trying to sugarcoat it. I think maybe some questions about how we got there.
Kyle, I think it's important to focus on the fundamentals. For years I've preached about interest rates and earnings. My opinion, what we're going through this year is a garden variety bear market. The stock market is doing what it's supposed to do, which is to reprice itself when interest rates go up. This sounds kind of complicated. It's not. Pretty straightforward in my opinion. If you want to value a company, you look as far into the future as possible to predict future cash flow. And because a dollar today is worth more than a dollar tomorrow, you have to reprice that future cash flow to get to a present value. So the simple point is the yield on the 10-year treasury's gone from 1.5% to 3% this year. So we're using a much bigger number to discount future cash flow, and that results in a lower present value. So stocks are doing what they're supposed to do, which is to reprice themselves to reflect those higher interest rates. You look at growth stocks having lost more money than value stocks this year. Pretty straightforward explanation. Companies like Apple and Amazon, Microsoft, Google, Netflix, throw in a few more, gush cash, very high levels of cash flow. So the higher the cash flow for a company, the even lower is the present value when you attach higher interest rates to that. So the value stocks that have moderate to modest cash flow, yeah, they're down for the year, but down 7-8%, not the 25, 26, 27% or more for the growth stock. So I think it's important for investors to know that stocks generally do not do well when interest rates go up. I think that, we lived through this fairly recently. In the fall of 2018, stocks were down 19%. A lot of people don't remember that because the next year stocks were up 32%. When the Federal Reserve reversed course and started lowering rates. Now, I'm not at all suggesting that stocks are going to be up 32% next year, but don't fight the Fed. When the Fed is raising rates, be careful. When the Fed is done raising rates and then lowering them, stocks generally tend to do a little bit better.
Well, and I think so important to have an understanding of the why, right? That it's helpful to look back and go, okay, well, here's how we've gotten to where we are. Because I think it sets the tone for what we should expect going forward. This idea that growth stocks sold off more than value stocks, for example. Well, okay, but there's a reason for that, of course. Understand that the reason we bought the growth stocks in the first place was for that higher cash flow. They're wonderful businesses. They're businesses that long term I want to be a part of. The fact that maybe they're at a little bit of a discount right now, okay, that's all right, as long as it's still a business you want to be a part of. And so I think some of the reminder that we've gotten from this market sell-off so far this year is, why are we really owning the things we are owning? What's the point of the stocks in our portfolio? What's the point of these businesses? And I think a reminder that there's a lot of great businesses out there.
Realistically, the Federal Reserve Board has been behind the curve. As recently as last November, the Fed said, no, we're not planning on raising rates. 2 months later, they said, not only are we going to raise rates, but it's probably higher than what the street is anticipating. So that tells me that, all right, they're behind the curve and they're going to have to raise, but there's a limit to how many times they have to raise. The issue here is that inflation is slowly coming down. Inflation numbers were at 9% in June. The personal consumption expenditure index buried inside the GDP reports. A couple of weeks ago, the government released their second estimate for second quarter GDP, and that personal consumption expenditure index number was down to 6.5%. So the trend is clearly your friend. Earlier this week, the market sold off in a dramatic way when the inflation numbers a little bit higher than what was anticipated, but still a lower number than June. So the point of all this is the inflation is gradually coming down, and as it does, there'll be a limit to how many times the Federal Reserve has to raise rates. And at that point, when it becomes clear to the street that the Fed's done raising rates, we'll be much more accurate in our estimates of what the present value of future cash flow should be. And that's when you start forming support levels for stocks. Read a report a little bit ago that was forecasting that the Fed was going to start lowering rates by next summer or early fall. So it's back to the cycle all over again. But in the middle of a bear market, Kyle, as you're well aware, I think it's really important to make sure you look at your balanced portfolio, knowing that this is why you own bonds, so that you don't have to sell your stocks or stock funds in a bear market to support yourself. And the way we like to manage money, most folks have years of withdrawals sitting in bonds, and the average bear market's over in 23 months. We're talking from the peak to the trough, back to the prior peak, on average 23 months. Even the financial crisis took most of us a little over 4 years to get our money back. So most people will find comfort and a little peace of mind in looking at their bond portfolios relative to what they normally withdraw from their accounts, because the whole point of building a balanced portfolio is to make sure that you don't have to sell distressed merchandise just to raise money to support yourself. You want to make sure it's balanced. So as inflation gradually comes down, whether it's going to be late this fall, into the winter, even next spring, I think it's important for people to connect the dots and see, okay, inflation is going to be coming down. There's an upper limit to how much the Fed's going to have to raise. At some point, whenever that is, moving forward, it'll become clear that the Fed is not going to raise rates anymore. And at that point in time, you form the underpinnings for the next leg up in the market.
Well, and I think so clear that the Fed, that inflation has been the thing that's driven the first half of this year. And so, as I mentioned earlier, this idea of why you're holding the things you're holding, there's a lot of high quality businesses out there. But if it takes that 23, 24 months to get back to the prior peak, well, January 3rd this year was the peak for the S&P 500. Okay, so if by the second half of next year, we're talking about a very different inflationary environment, a very different environment for the Fed to operate in, forget for a second the exact timing of that, but just the general direction, you start to get an understanding for how things could get better from here. You start to get an understanding for kind of this cautious optimism that we talk about when you look beyond just the current problems and look into what the opportunity set really looks like down the road. And so I think I'm very pleased overall with kind of the understanding of how we've got here, even if the results have been as poor as they've been, because we're following a path that I think we can understand. And most importantly, it's been very clearly tied to interest rates. And as we're fond of saying, it's earnings and interest rates. And I think seeing interest rates play the role they have played is such an important piece of kind of our understanding here.
Kyle, you're absolutely right about looking forward. Investors need to remember that stock traders typically look forward 9 to 12 months. We're not necessarily lining up bets for next week or next month. I'm more interested in what next year is going to look like. And I think the news is going to be better next year. So don't be short-term. Your focus for investors, it's so important to look forward almost a year. I want to get back to inflation just for a minute. Kyle, it's important to distinguish between the inflation we're experiencing now and the inflation that many of us lived through in the 70s and early 80s. Back in the 70s, early 80s, that was a wage price spiral, very different than the inflation for today. Wage price spirals are very difficult to stop. Ronald Reagan, Paul Volcker, 1980, if not now, when, if not us, whom, very famous words. They saved the country, but the downside is interest rates went to 18%. It created two serious recessions back to back, 80 and 81. Of course, that inflation was started when the Arabs stuck it to us, quadrupled the price of oil, doubled it again the next year, decimated manufacturing, particularly here in Milwaukee. The inflation this time around is simply explained because the world's factories were shut down 2 years ago into the spring and summer. spending shifted away from hospitality. People stopped going out to eat, stopped going to hotels, resorts, theaters, concerts, what have you, spent money on durable goods. And it's as if everybody decided that they needed to replace that couch in the sunroom that they couldn't take looking at anymore. There aren't enough couches to go around. So the fact that the factories were shut down, demand was up 18% from pre-pandemic levels for durable goods, something had to give. So fortunately, we're starting to see the bottlenecks in the supply chain get caught up slowly but surely. It's not a linear recovery. We're still dealing with the lockdowns in China that's disrupting the supply chain. And as a result of that, there'll still be hiccups coming, moving forward. But there's a fair amount of evidence that shows that, gasoline is coming down in price, that agricultural commodities are coming down in price, that the supply chain bottlenecks are being alleviated and unwound, and that's what caused the inflation. Now, of course, some of the stimulus money that was paid out in the spring of 2020 exacerbated the inflation, but that money's all been spent. I mean, that impacted the markets 2 years ago, not today for the most part. So because of manufacturing being very interested in satisfying demand, that's what they do, we're slowly getting caught up. And the point of all this is that if the inflation rates come down, that'll alleviate some of the problems in the financial markets vis-a-vis high interest rates.
And of course, we've seen spending patterns shift. We've seen more services spending, more travel spending now than what we saw a year or two ago. But the problem the Fed continues to have is they're looking at inflation always through the rearview mirror. So we talked about how stocks are forward-looking. Well, all of our inflation measures are rearward-looking. They're looking backwards. And so, of course, the Fed is constantly reacting to yesterday's news. And so far, that's been okay because the economic data, the underlying economic data, has been strong enough to support the Fed's actions. Of course, Jay Powell, in his comments at Jackson Hole this year, talked about the potential for economic pain because of the Fed's actions, but we need to be very clear in understanding that the unemployment rate in this country remains exceptionally low, that there's almost 2 jobs for every worker that's looking right now. And so as we talk about the impact of Federal Reserve decisions, as we talk about kind of this idea of a soft landing for the economy, there's maybe a little more runway for the Fed now than there has been in a while because of just how strong a lot of the underlying economic data is.
Kyle, you and I get asked almost every day about the potential for a recession. The rule of thumb, basically 2 back-to-back quarters of negative GDP growth, we've had that. But it's important to point out that recessions don't occur when the labor market is really strong. If you're working, you have money to spend, it's kind of that simple. When you look at consumer spending, strong. Up 0.3%. They just announced the numbers the other day, annualized 3.6%, pretty good number. So the point simply is, it gets unlikely to see a recession anytime soon when the labor market is robust, retail spending is pretty strong, and the other point is you're coming down from robust growth after the pandemic started, right? You had 4 months of misery, and then spending went straight up after that. So there was no way we were going to keep that up. So year-to-year comparisons get called into question because of that.
And I think it's so interesting to take some of that economic data and bring it into what we're seeing in earnings, right? To see what we've seen so far this year for earnings, with third quarter earnings growth looking largely negative with the exception of energy stocks. Energy stocks have really carried the year for the most part. Absent the earnings from energy names, we'd be largely flat in terms of earnings growth for the S&P 500. A lot of that is that year-over-year comparison you were just talking about, how strong the growth had been recovering from COVID. But also, we're fortunate to get the growth we've gotten from energy this year. As we look into next year, we're talking about earnings growth on the order of potentially 8%, and energy stocks go the other way. So at least forecasts right now calling for a pretty typical return to high single-digit earnings growth. It's a pretty positive sign for the long-term direction of stocks.
We used to talk about how we're the victims of our most recent perceptions, and if your perception in the bottom of a bear market is that things don't look so good now. I don't think things are going to be good in the near future. You got to be careful. Human beings tend to extrapolate their current conditions way into the future, as much as we may extrapolate current conditions at the top of a bull market, which is equally wrong. You don't want to do that at the bottom. We know longer term, 200 years plus of U.S. stock market history, that stocks tend to do higher than the inflation rate, that stocks tend to do higher than what bond holders get. And, the number's been plus or minus after inflation, roughly 7% a year. I'm reasonably comfortable to say that, over the long haul, stocks will do somewhere near that, the 7% rate. But, the problem is there's no direct correlation year to year. Earnings are up 8% doesn't mean stocks are up 8%. Earnings are slightly negative, stocks would go up. But longer term, in my opinion, you're much better off with growth in stocks than you are fixed income. It's important not to permanently impair your portfolio by selling when prices are at the bottom. Do whatever you can to avoid that trade. You're letting go of your life savings at a discount. It's something that we don't recommend. So folks need to keep their faith and avoid doing something that, after the markets recover, they're going to regret.
And with potentially about 8% earnings growth next year, stocks trading at about 17 times next year's earnings, a pretty attractive place overall to be, roughly in line with where some of the longer term averages have been for forward price to earnings multiples, especially when you compare it to the interest rate you can get on safer things. I think stocks look pretty attractive from here. Of course, you rightfully point out that growth isn't linear. It doesn't go one for one with the growth you're seeing in earnings. It doesn't even always match what we see in the economy more broadly, because there's a lot of noise. There's a lot of expectation that gets built into stock returns. But from a valuation perspective, there's plenty of good opportunities out there as well. And I think as we transition from kind of a market that's been so focused on risk off to a market hopefully next year where we have a little more clarity on what the end game for the Fed will be, this return to the growth part of the portfolio may be a part that does some of the heavy lifting again. Value stocks have been the better performing of the growth versus value conversation right now. But of course, as we look at the future, it's many of those growth names that have been able to have exceptional profit margins, that have been able to capture a lot of what the economy has afforded them. And so I think, the challenge now is exactly what you say: avoid selling your life savings at a discount, because many of those same names we've come to depend on will be things that carry us going forward.
Kyle, let's talk about the bond market here for a little bit. Bonds have not done well this year, as we're all aware. Interest rates have gone up. Frankly, the Fed blindsided the street in early January. They'd led everyone to believe that they weren't going to raise rates, and wrong, they're going to start raising rates. I think it's important for bond investors to remember why they own bonds. And, for starters, bonds give you the courage to own stocks. You need a part of your portfolio that's relatively safe. You need a part of your portfolio that's going to hold up traditionally better than stocks will in a down market. So we've been asked recently, hey, shouldn't I buy a 2-year treasury at 3.4%? What's wrong with that? Well, basically nothing. It's a pretty good trade, 3.4%, it's a decent yield. The way I view things, though, is I want the upside when it comes. At some point when interest rates go down, I want the upside on my bonds. So I'm not willing to give that up. If you look at some of the bond funds that we deal with, corporate bond funds in particular, where the yield's a little bit higher, 3.6%, but almost every business day of the year, those bond managers are re-upping bonds that come due at a higher rate, and it gradually pushes the yields up in the fund over time. So you don't want to lose sight of that as a bond holder, that gradually those bonds come due. You had pointed out a while ago that a lot of bonds were selling at a discount currently, so when those bonds come due, you don't get the discount price, you get the par of the bond, of course. And that as much as investors need to keep the faith in the equities market, I think the same is true with fixed income. I marvel at how quickly the yields jumped on the bond funds, where many of them were paying less than 2% a year and a half ago, and now we're heading into upper threes, maybe even the low fours by next spring. Quite a big jump in yield compared to what we were dealing with just a short time ago.
Well, and I think the key piece here is that you really can't expect more from your bond funds, from your bonds in general, than what interest rates can provide. Unlike stocks, bonds have a pretty clear end game. They're going to mature at par. And so if you buy a bond for 100, it eventually matures at 100. What you're getting for it along the way is that interest rate. And yeah, bond fund managers have some tools available to them to buy and sell at the right time, to try to get a little more yield as things come. We've seen that as in portfolios recently as bond portfolio or bond fund yields have started to rise. But the expectation is that over the next 10 years, the most you're going to get out of a bond is roughly what the interest rate was 10 years ago on a 10-year bond. And so if we go back a decade and we look at how low interest rates were, I'm not surprised that bond returns over the last 10 years have been as poor as they have. That was by design. The role of bonds is not to create these excessive returns. It's for stability within your portfolio. But here's the good news. With interest rates so much higher now than where they were 10 years ago, 2-3 times higher in a lot of places than what we could get 10 years ago, bonds can do more of the heavy lifting in a balanced portfolio than what they've done in a very long time. And so despite a little bit of a sell-off in bonds, candidly, one of the worst years we've seen in a very long time for bonds, I'm more optimistic about what the future looks like for bonds than I have been in a long time, because there's just more return from those higher interest rates than what we could expect. And so, again, I think balanced investors should be thinking, okay, bonds play a particular role in my portfolio, and now I can count on them a little more than I ever have been able to.
Kyle, I want to talk politics here for a minute. Our country is very polarized when it comes to politics. And I find myself having more and more conversations with people where I try to divest those thoughts when it comes to looking at their money. Because it's not about politics. It's about earnings and interest rates. And it's interesting to drill into what supports our economy. It's pretty boring, right? 70% of our economy is consumer spending. What's consumer spending? Going to the gas station to put gas in your tank, going to the grocery store to get groceries, paying your heating bill, paying your telephone bill, getting school clothes for the kids going back to school, getting ready to open your hockey rink, on and on and on and on. When we make those purchases, it's without regard to politics, right? When you get your next family vehicle, you're trying to figure out features and color and your price point relative to the political situation in this country. Doesn't even show up on your top 10 concerns as you're buying it. And so it's important, I think, to focus people's attention on really what drives earnings. And earnings drives stock prices. And so much of consumer spending is pretty straightforward, right? Most of us buy the same breakfast food week after week. Most of us buy the same kind of dinner food week after week. Doesn't change a lot. And you get, particularly when you get older, you fall into spending patterns. And those are pretty mundane, straightforward patterns. So I appreciate the fact that I've got clients that are political. I enjoy many of those conversations. But I find myself more and more stopping people before we get too far into those conversations to say, okay, but what I do is different. What I do is about earnings and interest rates. So I think about political events, but I've got to view it through the lens of how does that impact earnings? How does that impact interest rates? And in most cases, they don't. So I think it's important to, if you're astute, if you're plugged in, you're trying to pay the best attention as you can, to make sure that you realize that what drives stock prices is really straightforward. And as we started the seminar talking about math, It's a math. The stocks are repricing because of math. And those that get good at math get ultimately pretty good at understanding what moves stocks.
Yeah, they get rewarded for understanding that while we have to pay attention to the political conversations, while we have to understand, kind of the ebbs and flows of what's going on there, ultimately the American consumer is a powerful force. Ultimately, American consumerism is one of those things that's exceptional. And so the ability to drive the economy is not tied to political party, it's not tied to political affiliation, it's not tied to who's in power. It's tied to those very things that you talked about. A few of them a little too on the nose for me, buying school clothes, building a hockey rink in the backyard. Those are all things certainly that we do quite a bit of in our house. But it's true, I didn't make those determinations about whether or not I was going to put the rink up this winter, whether or not the kids were going to get a new pair of tennis shoes for the school this year based on who the president was or who was in Congress. We did it because they had to be done, because that's what you do when you're growing a family. It's what you do when you're growing an economy. And so I think that's the critical point, is understanding, yes, politics matters. Yes, it can have an impact, but it maybe isn't the outsized impact that so many people want to put upon it. I take that conversation and move it to maybe what's going on in Europe. The war between Ukraine and Russia rages on, and much of that political, but also it weighs fairly heavily on kind of the outlook for global stocks. In particular, Europe in for a potentially pretty tough winter. We've seen it already in how strong the dollar has been relative to the euro, but Europe is dealing with the same inflationary problems we are. The European Central Bank now on board with beginning to raise rates. They're finally starting to, I think, get a handle on that problem. But they're dealing with far bigger problems. And so at least for now, that focus on the U.S. consumer, I think, is a piece that's been a little more critical for us, with the understanding that there's some interesting ideas out there longer term, but a lot of stuff to be concerned about.
During times of uncertainty, specifically the largest ground war in Europe since World War II, money pours into the U.S. There's no place like the USA when times get tough. So the dollar is very strong, multi-year high. When you look at the other impact of the war, food prices skyrocketed. Ukraine was a huge exporter of wheat, so was Russia. But it's interesting the workaround the farmers did. They planted almost every square inch of dirt that could in wheat. Crop yields keep going up, so that's mitigated some of the problems. And you've also seen gas come down, right? Almost 60 days in a row now, gasoline has come down. Early on, when the war started February 24th, oil prices skyrocketed, natural gas prices skyrocketed, so it created a crunch. But it's interesting to see how the economies are doing workarounds, and we're not out of the woods yet. But aside from the human tragedy of the war, the impact on commodities prices in particular, pretty severe going into the springtime and the early summer. So the point of it all is, I'm not smart enough to know how the war is going to shake out. Seems that Putin at some point in time is going to declare some hollow victory and then go home. Pretty hard to call it at this point in time. But from the financial markets impact, to me it looks like we've absorbed the bulk of it. I'd like to see the dollar weaken some. The problem with a strong dollar is a big problem in the emerging world. If you're in Malaysia, you borrow $1 million in dollar terms for your business, your currency goes down 20% against the dollar, you effectively owe $1 million too. And that's at a time when your economy is struggling because the dollar is so strong. So after the financial crisis, as you know, a lot of companies had to borrow in dollar terms. Well, you got to pay that back in dollars, not local currency. So it creates pressures. And of course, for the multinationals, many domiciled here in the United States, when you repatriate foreign earnings back to U.S. dollars, you don't look as good because the dollar is stronger. So I think it'd be to everyone's benefit to the dollar to weaken a little bit. But of course, because of the political uncertainties of the war, in particular, the dollar got strong. So my guess is the dollar will start weakening 2-3 years out, and then we'll go back to making some money overseas.
And what I appreciate about so many of these conversations, these uncertainties have answers. We don't always know what those answers are going to end up being, but we know that there is an end game that will come. Inflation, the war in Russia and Ukraine, even COVID to a certain extent, while it rages on, there is some point in time in which places like China will figure out how to better deal with a zero COVID policy that they're currently operating under that's continued to weigh on supply chains. But all of those answers take time. And so, I think it gets back to that conversation of balance, right? It gets back to the importance of having pieces of your portfolio that you can be fairly certain are going to be roughly what you think they should be worth, because it allows you the time you need for those answers to make themselves apparent. Even for the things that, the meteors from outer space that we talk about, the unknown unknowns, even those things are going to have answers, but we need to get from what the question is to the ultimate end result, which takes time. And so I think as we look at what the next couple of years bring, some of those questions are going to have answers in 6 months, a year, 18 months. Some of them might take a little bit longer, but the market's not waiting for that. The market's anticipating what's going to come next. And so I think as we kind of look at what's coming down the pipe here, as we look at what the opportunity set is, okay, with earnings set to increase at hopefully 8% next year, looking a year later, forecasts calling for high single digits as well, and still very much too early to say for sure, but there is optimism on the horizon. And so, I think my general outlook here is that I'm more pleased where we are now, in part because of how we've got here, about what the path forward looks like.
Kyle, you and I were both taught to do year-over-year comparisons with economic statistics. For a pretty good reason, the month-to-month numbers tend to be fairly volatile. But you got to be careful with that when you're at inflection points for the markets and the economy. Anecdotally, we can see that inflation's coming down, but you look at the year-over-year numbers, you'd hardly know. Anecdotally, we can see commodities prices, some other items that are coming down, but year-over-year numbers, you can hardly tell. So when you look at the month-to-month numbers, again, take some of them with a grain of salt because they tend to be volatile, but it's at a time when the year-over comparisons aren't going to do you a lot of good. So why I'm telling you all this is that it'll become really obvious late in the year, early next year about inflation, but the anecdotal evidence suggests that the trend is already underway. And there's a time when the market moves. I mean, it's like forward earnings. You only go out a year, but if you're calling it from the bottom of the trough, the next 12 months may not look that good. So you got to be careful with that as well.
Yeah, and I think that's the key, right, is understanding that the data is only as good as the time period you're looking at, understanding that you bring in another month in the back end or you take another month off the front end and all of a sudden things look very different. And so I think as we move through fall into winter and especially into spring and next year, a lot of reasons to think that the very problems we're talking about right now either become less of a problem or even in some cases are moving in the other direction. And so, I'm again very pleased with how well we've done compared to kind of what the world has been going through more broadly. This has been a very tough stretch, not just this year, but coming through COVID. And yet, here we are looking at 3-year numbers that are quite exceptional for many balanced portfolios. And I think sometimes we miss that looking at just the pain that we've dealt with, really from the start of this year.
Kyle, I get asked a lot about China these days. For the life of me, I can't understand why they cling to their ineffective vaccine, and their strategy's been to lock down cities. It's been wreaking havoc lately with the supply chain. But I think more importantly, you have problems in the real estate sector where, they've got this sense that build them and they will come. You've got millions of apartments that they're paying mortgages on them and they haven't been completed yet. So there's some clear cracks in their economy. And the reason why I say this is it'll impact global GDP. I mean, they're down from the glory days of 7% plus per year increase in GDP. Best guess this year it's going to be in the 2.5% to 3% range. But they have an emerging middle class that's one of the largest in the world. And as they slowly transition to a consumer-based society, from being so focused on building infrastructure, it'll be bumpy. We've known that for years. But I think China is going to be the story the next couple of years to pay attention to.
Yeah, you don't change direction overnight as an economy, and there's some hiccups along the way, but as China transitions to a more consumption-based economy, much like the U.S. has been, as that middle class becomes the piece that drives, the economic growth, as that middle class becomes the economic engine for China, I think there's every reason to believe that many of the predictions about not just China, but the world more broadly come true, that we get a little more growth from there than what we've seen, and hopefully can trust it a little more than some of the numbers we've seen in the past. Certainly that's a big part of the problem, is trusting the data that comes from there. But as that becomes more transparent, again, I think you're right on there. China's certainly going to be a big part of the conversation for the next couple of years.
I want to shift gears just for a minute here and talk about big picture, long-term stuff. As you know, there's only two components basically to GDP growth. Gross domestic product, the broadest measure of goods and services produced in a particular country. Only two components, easy to explain. Increase in the workforce, right? And making people more productive. How many pens can you produce an hour? When I got out of high school in 1970, fewer than a third of the women in the United States worked outside the home. By the end of the century, it jumped to over 2/3. And so it counted for much of the GDP growth in the 70s, 80s, and 90s. Just women simply entering the workforce. Here's the point of it all. You can't see a 2.5-fold increase from 70%. Can't happen. So the number of people in the workforce is slowing down, as you would expect with a fairly stable population. The other thing is productivity growth. Now here's where, to me, it's very encouraging. One of the byproducts of it being difficult to hire is the impact of robotics. I heard of a story recently about a big contractor down in Chicago couldn't hire enough bricklayers. They got robots to help do the job. More and more factories that are going dark where there aren't any humans on the factory floor. The introduction of artificial intelligence, machine learning, augmented reality, in the future, the likelihood of a pretty good increase in productivity, it's on the horizon. It's hard to say exactly when and where and how and all that, but, with the absence of any easy sign that the workforce is going to increase, all the pressure is going to be on productivity growth. And, I'm starting to get really encouraged when I see more and more companies embrace robotics. I'm more and more encouraged to see that they're teaching robotics now at the junior high school level, let alone the high school and college level. That's fabulous. And that, as a society, we're learning to, how better to apply all the wonderful technologies that's out there. Didn't even mention nanotechnology that, interesting, King Charles III had helped pioneer decades ago. So we're just on the edge, in my opinion, the cusp of enjoying the benefits of that type of technology vis-a-vis the component of GDP that'll be so important for future growth.
And of course, driving earnings growth, because once you've made that investment in that robotics or that artificial intelligence, yeah, you've got to maintain it, you've got to upgrade it, but those are significant upfront investments that pay dividends over the long run, that should make their way into profit margins, that should make their way into the bottom line. And so, I think from an investment perspective, incredibly excited about the opportunities that brings, because again, that's the thing that drives earnings growth into the future. Of course, we have an aging workforce. We have a workforce that continues to look a little different than what it's looked like in the past. The good news is we're able to fill in some of that with the very things you're talking about, as well as all kinds of new technologies that you and I haven't even thought of yet, but that some really smart person's going to come up with to solve those very specific problems we're talking about. So I think one more reason why I'm very optimistic long term about what the prospects are for stocks.
Thank you, Kyle.
Thank you, Bob.